Year to date, Newmont stock is up 30% on the TSX. I'm with CEO Tom Palmer at the Mines and Money event. Tom, you had a solid year end, which may be overshadowed if these gold prices keep up. What would you like to highlight?
It's very solid 2021, Michael, and I think very proud of the work that our team have done in the context of managing through the impacts of the pandemic through all of last year. But we finished the year within our guidance, 6 million ounces of gold for the year, an additional 1.3 million gold equivalent ounces from copper, silver, lead and zinc. So pretty significant contribution to our portfolio from other metals. Combined our gold all-in sustaining cost about $1,060 an ounce, and the combination of that production and that unit cost, we generated attributable free cash flow of some $2.6 billion. So a significant amount of free cash flow generated through 2021. On top of those headline numbers, we commissioned the gold industry's first autonomous haulage fleet at our Boddington mine in Australia. Just earlier this year, if I included in 2021, we acquired Bonaventura's interest in Yanacocha, so we now own 95% of Yanacocha and the very exciting sulfides project that comes from that. And on the back of that free cash flow, we returned more than $1.8 billion to shareholders through dividends and repurchased some $525 million of shares at about $57 a share. So pretty good buying when you consider where our stock sits today.
Tom, there's a lot of pieces that I want to follow up there, but let's first talk about this volatility. When an investor sees these big swings in the gold prices, is there any rule of thumb for senior gold miners? How meaningful is a $100 jump in the price of gold?
Significant meaning in a $100 gold price difference if you continue to run your business with discipline. So one of the hallmarks of Newmont is the discipline with which we run a very long life business. So we set our reserves at $1,200, assuming gold's at $1,200. We build mine plans around that base. We then flex that to understand what we do differently at $1,500 gold and $1,800 gold at an individual asset level. So we then make specific decisions when the current gold price is higher. But we have the discipline to run our business at that $1,200. We then spend $1 billion a year and can afford $1 billion a year in sustaining capital at that $1,200. We spend $600 to $800 million a year on growth capital at that same assumption on gold price. We spend around $400 million a year on exploration and studies into future projects at that gold price. And we pay a $1 base dividend at that gold price. That then allows us, with that discipline with which we run our business, to be leveraged to high gold prices. So for every $100 increase in gold price above that $1,200 base, we generate $400 million of free cash flow every year. So at current gold prices, if we assume they're $1,900 or a little bit above that today, that's about $2.8 billion of free cash flow that we're generating over and above that base case discipline with which we run our business. And importantly for Newmont, 99% of that free cash flow is attributable. It goes into our bank accounts and is available for us to use to return to shareholders. And we have a very clear dividend framework that we introduced back in October of 2020, where we'll return between 40 and 60% of that additional cash flow through a dividend over and above that $1 a share base dividend. So we're currently paying $2.20 a share on an annualized basis in a dividend. That's generating a yield of over 3%. That has us leading the gold industry. That has us leading the S&P 500. We're the only gold mining company listed on the S&P 500. And we're in the top 10% of dividend payers on the whole of the S&P 500.
Now, Tom, Newmont is touting its dividend, but you are a gold miner. There's a lot of emotion about gold, more so than other industries. Shouldn't there be more of an emphasis on talking about growth and then talking about acquisitions? Isn't that something that's really going to excite the investor base?
We don't see that in our investment thesis. There are four things that are driving investment into Newmont stock. And our investment thesis or our strategy or value proposition has 4 pillars to it. The first is our ESG practices and leadership is a differentiator for Newmont. Has been for a long period of time, is very much part of the fabric of the Newmont story. The second one is the portfolio that we've engineered, particularly over the last 3 years. So we have, as a gold mining company, a portfolio of 12 managed operations and 2 joint ventures that is very long life. We can maintain 6.5 million ounces of gold and another 1 million to 1.5 million ounces of other metals. So around about 8 million gold equivalent ounces for all of this decade and well into the next, with 20 organic projects that we have in our project pipeline that we can bring through and extend the life of our portfolio. So the growth for Newmont, when we think about our portfolio, is growth in margins and growth in mine life. And then we support that portfolio with our third key differentiator, which is our operating model, combined with our experienced bench of leaders. That really sets us apart in terms of the discipline with which we manage and govern a portfolio of operations around the globe. And then the fourth piece of our story, our investment thesis, is our capital allocation discipline. The money we reinvest back into our business, the strength and stability of our balance sheet, and then the clarity with which we are returning excess free cash flow to shareholders through our dividend framework. It is those 4 things that are driving the investment thesis for Newmont, and it isn't a thesis that's around a growth in gold. It's about a very long life, stable business run with discipline and delivering predictable returns over the long term.
What would you like to highlight on the organic growth story? I've noticed that the most recent news releases that you've had, they've kind of had a Northern Canadian bent. I see what happened with coffee, and then also recently announcement up in the Golden Triangle, Tom.
Yeah, thanks, Michael. The 2 recent announcements, coffee up in the Yukon and Saddle North in the Golden Triangle, are 2 very exciting projects that are a little bit further into our future. So we're really starting to look at positioning ourselves in Western Canada, both Yukon and the Golden Triangle, really looking at what might be mines in the Newmont portfolio towards the end of this decade. So what you'll see in a Newmont investment thesis is us deliberately making investments, positioning this business for the next decade and the decade beyond that. More near term, we are going into one of our most significant reinvestment periods in the 100-year history of our company. So we are currently investing around about $750–800 million in a production shaft at our Tanami mine in Australia. We're investing around $850 million in a new mine in Ghana, Ahafo North, only 30 kilometres from our existing Ahafo complex. And we are continuing to advance and looking to have a full funds decision towards the end of this year, the conversion of our Yanacocha mine in Peru, a mine that's been part of the Newmont portfolio for over 30 years. We're looking to invest around about $2.5 billion to be able to install the processing infrastructure to be able to process the sulfides ore that sits throughout that area, and will allow us to produce of the order of 500,000 gold equivalent ounces every year for literally decades, made up of about 50% gold and about 50% copper. So sulfides, Ahafo North and Tanami 2 are our 3 near-term investments. And as I say, the combination of those 3 projects really represent some of the most significant reinvestment back into our business in a 100-year history of our company.
Two-parter, Tom. Is Newmont impacted at all by the Russia-Ukraine conflict? And also, is there anything that's a wider impact upon the gold supply, such as disruptions from Polyus and Kinross?
Michael, if I may, I just pass on our thoughts and prayers to the people of Ukraine that are being impacted by this terrible and unnecessary war. And unfortunately, gold price benefits from that war, and as a consequence of a move to some safe haven and gold. And we don't run our business looking for that sort of geopolitical instability. I'd much prefer not to have that sort of conflict. So we are seeing gold price sitting up in sort of started hovering in around that 1900 to 1950, really linked to some of the instability associated with that conflict. But that's on top of a gold price that was sitting pretty firmly in and around the $1,800 mark and 1800, 1850, due to the level of fiscal and monetary stimulus that's been associated with various governments' response to the pandemic. There's certainly the inflation that we're seeing around the globe, and supply demand in terms of gold. So there's some pretty robust foundations that support gold staying at around about that 1800, 1850 level for some time to come. And then we're seeing the impact of some geopolitical instability that's having some of that volatility on that gold price. Beside Ukraine, the one that we watch is what China might do as a response to the pandemic, as they continue to try and manage zero COVID cases in that country. If that were to change, I think that's the event this year that may have an impact on gold price that we're keeping an eye on. In terms of gold supply and some of the gold miners in Russia, not expecting that to have a significant impact on gold supply globally. I think the actual conflict itself is going to have a more significant impact on supply. And then we're seeing some input costs that are coming as a result of either oil prices or, in the mining space, the impact on natural gas and ammonia that comes off natural gas for either explosives or cyanide. So seeing some input cost impacts, but not really gold supply side impacts that are material.
I'll congratulate you on your production report. Not only did you talk about the impact of cost of gold, but you also talked about the impact of cost of oil. But let's talk about that. How are costs right now for those inputs? And I imagine as well too, you do have a lot of initiatives around renewables, electrification, but I don't think there's really much that you can mitigate in the short term around oil costs, Tom.
Yeah. So energy makes up of our operating cost base. Energy makes up around 15% of our base, and it's predominantly diesel or in some instances some fuel oil that we use for generating electricity. In terms of our sensitivity to increases in the cost of oil, about a $10 a barrel increase represents about a $15 million impact on free cash flow in a year for Newmont. Now, if you correlate that to gold price that we talked about earlier, a $100 increase in gold price, $400 million of free cash flow that we generate. So there is a strong correlation between the elevated gold prices and the elevated oil prices. So gold price is more than offsetting any impact to our free cash flow from those elevated oil prices. So that's something we continue to monitor, but we're certainly benefiting from the commodity price.
How's labor? What's the top pain points?
Yeah, labour is a more substantial input cost for us. So about 50% of our cost base is labour. That's not just our employees, but that's all of the contracted services, all of the other labour that comes in to do work, big maintenance shutdowns, or the various the people that might be providing the catering and cleaning at an accommodation camp and so on and so forth. So we are certainly seeing in big mining communities like Australia and Canada, where there is a demand for labour, escalation in labour costs, and of the order for us, if I put it into context, Michael, if we have a year where gold's at $1,200 in a base case planning scenario, we would typically see inflation or escalation in labour costs of around 2%. In the current environment, we're seeing that sitting up around 5 to 7% in terms of those escalations. We've signalled that to the market. It's built into our guidance for this year, and what we're seeing as we move through the year is about the rate we're seeing. So we're certainly seeing the impact of a hot labour market in a couple of those big mining centres in Australia and Canada.
Rio Tinto released a report on harassment at its workforce. Painful reading. Over a quarter of the women reported being sexually harassed. At remote sites, female employees reported eating alone in order to avoid being out at dark, avoid harassment. Terrible report. Obviously something that any company is going to be acting upon. I was interested what it was something that you can do though on a basis. This is something that you have to act on. So how do you do it tactically? How do you do this as an initiative? And then also, how do you measure that there's follow-up? How do you measure that there's inclusivity, Tom?
Yeah, thanks, Michael. The report that Rio Tinto issued, and in conjunction with that, in the West Australian natural resources industry, there was a parliamentary inquiry into remote sites, and both of those reports are confronting reading. And as a leadership team, we've spent quite a bit of time reflecting upon those reports and thinking about the things that we can do as a leadership team to ensure that we are creating, maintaining, and improving a workplace culture, a workplace environment that is inclusive, that is safe, both physically and psychologically, and people can live and work at Newmont and be confident that they're free of discrimination, harassment, bullying, or violence in any form. There are a couple of things that, as we reflected on that report, that stand out for us. This is not an issue that is limited to one company, to one industry, to one country, to one culture. It is an issue that is in society at large. So if you read a report like that and say, that's not us, then I think you need to go back and have another read, because there is evidence, there is stories there that compel every company, every industry to take action. The second one for us is that this is not a problem that is linked to or due to women, people of ethnic or racial minority, LGBTQI+. This is an issue of power and privilege, and the people who have power and privilege within organisations. And that's certainly in the mining industry, and more broadly, that is predominantly men. So if we're going to make a change, then we need to think about how we change the behaviour of the people that live and work in our company, and particularly men that work and lead within our company. So we are taking a number of actions to look at what we can do in that space. One is to actually name the problem and to start to have some direct and uncomfortable conversations around the problem and what we need to do to change. Because without the dissonance that comes from an uncomfortable conversation, we will not change behaviour. We have a very robust business integrity and compliance process. So we do identify issues of bullying and harassment and other things within our company. And as we run those investigations very rigorously and robustly, what we'll be looking to do going forward is be more transparent about those cases when we have them, and if there's a consequence for someone, to be more transparent around why there's been a consequence for someone as a consequence of that unacceptable behaviour. And I think we need to have the courage to be more transparent to ensure that we are creating a safe workplace, an equitable workplace for our workforce. And then the final thing, Michael, that I've just made the decision to do is to appoint a very senior leader in our business, a senior vice president who understands our business intimately. And he will be reporting to me, and it's deliberately a man who I've chosen to take on that role. He'll be reporting to me and helping me and my team put in place the actions over a number of years that can sustainably improve the culture of our organisation.
I was interested at the start that you bullet pointed what you're doing around autonomy. Now, you know, in this industry, about half a dozen years ago, when you went to the Mine Expo, it was all about AI. It was all about autonomy. Now it's been overshadowed by electrification and renewables. interest is going to swing back to autonomy when people get back to this and they look at it. How far ahead are we going to be over the years where, I don't know, it's been a little bit off the headlines?
Yeah, the move to decarbonise, so the move to achieve targets on greenhouse gas reductions by 2030, and we've set ourselves 18 months ago the target of a 30% reduction in scope 1, 2 and 3, and then through that to net zero by 2050. That move to decarbonise is going to need to have electrification and automation coupled together. So if I get in the time machine and look forward to 2030 or 2040, what does a mine of the future look like? They will be powered by renewable energy, whether it's wind or solar. That brings electricity in off a grid of some sort to power the processing plant. That power line will then go down into the mine, whether it's an open pit or underground, and it will be being used to recharge batteries on the equipment in the underground mine. And in order for that, or open pit mine, in order for those mines to then operate efficiently and effectively, you are going to need automation to ensure that that equipment is getting to its recharge bay or being recharged as it drives through a haul cycle to ensure that you've got the level of productivity you've got today with conventional equipment. So for me, the work around renewable energy, the work around decarbonisation and automation are intimately linked. And that's linked to and that's part of the strategic alliance that we formed with Caterpillar. We're looking to work with Caterpillar to disrupt the relationship between an equipment manufacturer and a mining operator. That we need Caterpillar to disrupt their product development cycle, and we need to challenge ourselves in terms of our traditions around how we develop and operate a mine. And so we're working with Caterpillar to develop both an underground haul truck and an open pit haul truck that is both battery electric and automated, and to do it in a time frame that it can be in and operating as a fleet, a frontline production fleet, before the end of this decade. And we're targeting 2026 for those dates. So automation and electrification are going to be hand in glove. And if you're not looking at automation solutions within your existing operations as a base case to take elsewhere, then you're going to miss the bus in terms of the steps needed to achieve 2030 targets and then ultimately get to net zero through the following 20 years or so.
When this matures, the economics of doing a mine are going to be looking quite different, Tom. I imagine that you will be looking at projects and having to assess them differently.
It will provide different opportunities around how you think about power supply for those projects. But one of the most exciting things about automation is how you think about a mine design. So if you think about an open pit design, they are still designed such that you have haul roads going in and out of that pit that are spaced double width for conventional haul trucks. So you've got enough room for two trucks to pass each other, assuming human beings are driving those trucks, and then having a margin of error in terms of if there were to be an interaction, there's some ability to operate safely. With autonomous technology, they will follow the same path every time reliably. So once you've got the confidence in that technology, you can then revisit mine designs, and you can look at whether you can reduce the width of those haul roads. They can go to single width. And when they go to single width, then you can look at what the steepness of the walls of those pits would be, what the waste is you need to move, and that starts to potentially significantly change the economics of some very large mining projects. Just one example of how this sort of technology, I think, will change the economics of mines going forward.
Industry people say that there should be some consolidation in the gold sector, certainly around kind of the mid-tier. How do you see this? Is it something that you believe, Tom? And is there a way that you could see this getting done?
Certainly, when you look at the gold industry, there's an order of magnitude more publicly listed companies than any other commodity in the mining space. And if you were to add up the market cap of every gold company, I think it gets to about 25 or 30% of the market cap of Apple. So just that alone says there are too many gold mining companies out there, and there needs to be a level of consolidation over time. The other thesis that we have to our earlier conversation, if you look at the steps a mining company will need to take in order to be on the journey to get to 2030 targets for greenhouse gas reductions and ultimately to net zero, you're going to need to have scale and life to underpin these sorts of investments around renewable energy and the technology necessary for running mining companies into the future. And our thesis is that as we look through this decade, it's going to be the decarbonisation journey, the greenhouse gas reduction journey that's going to start to drive consolidation, because companies are going to need to have scale and life in order to underpin those investments. Otherwise, they won't attract the capital for some of those future mines. In terms of Newmont's role in that, we've engineered a very robust long life portfolio. We've got an organic project pipeline that is second to none in the gold industry. I would argue one of the best project pipelines in the mining industry, particularly with the amount of copper that we have within our project pipeline. But that doesn't mean that our radar is not turned on, but we have the discipline in terms of what would need to trigger our radar, and we have a definition of a world-class asset. So it's a mine that's got at least 10 years life, producing at least 500,000 ounces a year, all-in sustaining costs of around $900 or less, and most importantly, in the right jurisdiction. We're very clear about where we choose to operate matters. So if out there within the industry something came up on our radar that hit those filters, then we'd have a good disciplined look at it. And if it complemented our portfolio, we'd be involved. But it's not something that we're distracted by. We've got plenty within our portfolio to keep us busy for literally decades.
Tom, thanks for your time.
Great. Thanks, Michael.
He's Tom Palmer. He is the CEO of Newmont. My name is Michael McCrae, Mining Audience Manager at KITCO.